While sleepy income stocks haven't been leaders, they may return to favor in 2025. As we close out 2024, it's worth noting that the stock market has been very risk-on over the last few years. The S&P 500 is tracking a roughly 27% gain on the calendar year, after a 26% gain in 2023. In an environment like that, growth-oriented stocks tend to be the biggest drivers of performance. What's more, comparatively higher interest rates versus the previous near-zero environment a few years ago have brought bonds back into favor for many investors. After all, if you can get almost 4.4% in rock-solid U.S. Treasury notes, why settle for the meager 1.4% yield? That's the average for S&P dividend stocks right now. Given these circumstances, it's no surprise that the highest dividend-paying stocks in the S&P 500 index have underperformed. Dividend stocks generally offer a value-oriented approach with income potential rather than chasing significant earnings or sales growth. That said, past performance is never an indicator of future returns, and in 2025, if the going gets tough, then high-dividend stocks may find favor with investors who find growth harder to come by. The following 9 stocks have all admittedly had their struggles, but as of this moment, rank as the leading S&P 500 dividend stocks. Here are the top dividend yields in the benchmark index, in ascending order. But before we get to this awesome list, if you could hit that subscribe and like button, it shows the investing gods that you want to build your wealth for the future. Ford Motor Company, ticker F, dividend yield, 6.2%. Ford has not had a particularly good run lately, with shares cut in half from their 2022 high and down about 20% in 2024, despite the broader stock market moving about 20% to the upside. Part of that remains its challenges with vehicle electrification, with heavy spending in its EV division that has gobbled up operating profits. At the same time, Ford has struggled generally to connect with its brand in China, which is now the largest vehicle market in the world. Ford is only paying 60 cents in annual dividends, which remains just about 1/3 of operating profits. However, it is also saddled with roughly $150 billion in total debt, so there's a real risk of financial stress that squeezes dividends in the future. For now, however, F stock is among the highest-paying dividend stocks in the S&P 500, after recent declines in dividends that have thus far avoided any rollbacks. Franklin Resources Inc., ticker BEN, dividend yield, 6.4%. Franklin Resources has seen its shares decline nearly 30% over the last year, thanks to a recent Securities and Exchange Commission investigation into unlawful practices within its Western Asset Management Macro Opportunities Fund. The good news is that the firm remains one of the biggest players in the world, operating under the global brand Franklin Templeton Investments. Recent tallies show assets under management hit $1.65 trillion as of November 30th, up slightly from the end of October, and above the $1.41 trillion at this point in 2023. That's a good sign. The stock's 32-cent quarterly dividend is still intact and providing a generous yield for the time being, but there's clearly a lot of uncertainty around just how big a fine it may face, and whether investors will remain confident putting their cash under management at Franklin Resources in 2025. Pfizer Inc., ticker PFE, dividend yield 6.6%. Though it made a name for itself as a vaccine leader with its first-to-market COVID-19 shot, Pfizer has struggled mightily lately. Shares have been roughly cut in half from their 2022 highs, thanks to both declines in that specific drug's sales as well as broader challenges with the pipeline of new vaccines and treatments. In the case of Comirnaty, the branded PFE vaccine for COVID-19, sales have crashed 66% year over year. And in the case of new treatments, Pfizer has run into serious walls developing an obesity blockbuster, even as competitors have been cashing in on this lucrative segment of the healthcare market. Admittedly, PFE isn't going anywhere. The firm has roots tracing back to 1849, and it has a reliable and sustainable dividend. That said, it is also one of the riskier pharma stocks right now. Crown Castle Inc., ticker CCI. With a dividend yield of 6.7%, Crown Castle may not be the best-known S&P 500 stock, but its recent declines risk making it one of the most infamous in the index as we close out the year. CCI stock traded around $200 a share to start 2022, but now trades at half that price. Worse, momentum is looking decidedly unpleasant, as Crown Castle has shed about 20% since September. CCI operates more than 40,000 cell towers and another 90,000 miles of fiber optic cables, making for a very capital-intensive business, and one that is particularly sensitive to interest rates. What's more, CCI isn't technically a communications stock but rather structured as a real estate investment trust, or REIT. This special class of company must deliver 90% of taxable income back to shareholders, meaning a great mandate for dividends, but not a lot of wiggle room operation-wise. The question for investors then is whether the generous payday is worth the risk of continued share price declines in this high-yielding S&P stock. Verizon Communications Inc., ticker VZ. With a dividend yield of 6.7% since the pandemic-era disruptions, telecommunications leader Verizon has struggled significantly, with shares dropping from more than $60 per share in December 2020 to around $40 presently. That's partially because its massive network is already as big as it can get, barring major problems for its sister providers AT&T Inc. T and T-Mobile US Inc. TMUS. It's also because of similar challenges faced by Crown Castle, namely, fiber optic cables and cell phone towers are very expensive, and comparatively higher interest rates make Verizon's borrowing more expensive than just a few years ago. That said, with projected annual earnings of about $4.70 per share, it can more than cover its recently increased dividend of $2.71 per share annually. Dow Inc., ticker Dow, dividend yield 7%. Not to be confused with the industrial average that competes with the S&P 500 index, Dow Inc. is a chemicals and materials company that provides packaging, coatings, and other products. As a raw material stock, it is inherently susceptible to inflationary pressures and has seen headwinds lately as a result. Adding to challenges have been numbers indicating generally soft demand, even before these pricing issues. Admittedly, its dividend is generous. However, earnings forecasts for the next year are at or below the current payout, meaning future dividends are very much at risk. With general struggles over the last year or two coupled with a rough outlook for 2025, the future is uncertain for this high-yield stock. Liondell Basel Industries NV, ticker LIB. Dividend yield 7.2%. Lyondell-Basell is a specialty chemicals company that is one of the world's largest producers of plastics and resins. The good news for LIB investors is that its products are an integral part of a host of economic activities, and thus should see strong baseline demand in any environment. The bad news, however, is that, like fellow chemicals maker Dow, it is uniquely susceptible to inflationary pressures as input costs change and squeeze its margins. What's more, recent talk of trade wars augur potential disruptions to this multinational player's business outlook for 2025. Shares have fallen almost 25% from their October highs as a result of recent headwinds. Still, after a dividend increase this summer brought quarterly payouts to $1.34, almost double the 70 cents per share it paid in 2014, Lyondell Basel remains a high-yield stock that is connecting with investors. Whether the headwinds cause continued share declines to offset that income potential in 2025 is anyone's guess, however. Altria Group Inc., ticker MO. Dividend yield 7.7%. Tobacco giant Altria is a leading S&P 500 dividend stock that continues to deliver. Sure, its Marlboro cigarettes, Black and Mild pipe and cigar products, and Copenhagen smokeless tobacco won't be seeing breakout growth anytime soon thanks to the obvious health problems associated with these products. Still, tobacco remains legal and in demand, particularly the brands that Altria offers to its loyal customers. MO has reliable revenue and a strong history of 55 consecutive years of dividend increases that prove its power for income investors, and with a yield that is more than 5 times its peers in the S&P, it remains one of the most generous stocks on Wall Street. Walgreens Boots Alliance Inc., ticker WBA. Dividend yield 10.3%. Pacing the worst performance of any stock in the S&P 500 index, Walgreens has the largest dividend yield at present thanks to a consistent downward spiral in share prices. Shares are down more than 60% year-to-date thanks to disappointing performance, including a quarterly dividend cut from 48 cents to 25 cents in its first payout of the year. There's no guarantee dividends won't be cut again too, as profits are set to slump by nearly 50% compared with the prior year. Time will tell whether the current turnaround plan pays off and stabilizes this troubled pharmacy retailer. But for whatever it's worth, WBA stock ranks as the highest-yielding S&P 500 component right now. Just don't take that as an endorsement for how the stock will perform going forward.